Welcome to The Explainer. Today, we're diving into how one single policy decision can trigger a massive, high-stakes domino effect across the entire globe. We're going to follow the story of China's giant textile industry as it's forced to navigate a pretty sudden and intense trade storm.
So to get this, let me just ask you a question. Imagine you're running a huge business, and literally overnight, your number one customer, the one you rely on most, just decides to walk away. What do? I mean, where do you even begin to turn? Well, that's the exact massive dilemma that an entire industry found itself facing. Okay, so picture this. It's May 2025. For the folks exporting textiles and clothing out of China, this was not just another month on the calendar. This was the moment a simmering trade conflict it boiled over into a full-blown crisis. It forced companies to make incredibly risky decisions, and they had to do it fast.
And this number is really the heart of the crisis. In just 1 month, textile and apparel exports to the U.S. absolutely plummeted by nearly 20% compared to the year before. A drop that steep, that fast, it sent shockwaves through the entire supply chain.
All right, let's get into it. To really understand this big pivot, first we have to understand what caused it. What was the big push that led to this sudden collapse in trade with the U.S.? Well, the answer comes down to one word: tariffs. A new U.S. tariff policy came into play, and it was a total game changer. Suddenly, the cost for an American company to import certain Chinese textiles could just skyrocket, with the tax rate, the duty, climbing as high as 54%. Now, that is not some small little tax. For a lot of these businesses, that's enough to completely wipe out any profit. And the effect was immediate. It was brutal. You can see here, after months of some ups and downs, but still overall growth, the bottom just completely fell out in May. That one drop was so bad, it erased all the gains from earlier in the year and pulled the whole trend into the negative. The shock was real. Now, global trade is a bit like nature. It can't stand a vacuum. When Chinese goods suddenly got way more expensive for buyers in the U.S., those buyers didn't just decide to stop buying t-shirts. Nope, they started looking for new places to get them.
And this is a snapshot of who was waiting in the wings. This is from April, right before that huge drop. You can see China still had the biggest piece of the pie. But other countries like Vietnam, India, and Bangladesh were already huge players, and they were more than ready to step in and fill that gap.
So, with the door to its biggest market slamming shut, China's textile industry had to find a new door, and they had to find it fast. And that brings us to the next part of our story, the huge strategic turn toward Europe. And wow, what a turn it was. In the very same month that exports to the United States cratered by almost 20%, exports to the European Union shot up by almost the exact same amount. That is not a coincidence. That is a deliberate, calculated pivot in action.
And this wasn't just some one-month fluke either. This incredible growth was actually part of a very clear trend. For 3 straight months, exports to the EU had been growing at this blistering pace, over 15%. It shows you that these exporters were actively and very successfully redirecting their shipments.
Now, what's really interesting is where in Europe this growth was happening. They weren't just pivoting to any small market they could find. They were making a direct push into the EU's biggest economies. Look at this. Exports to Germany up 36%, the Netherlands up 31%, France up 24%. They weren't just looking for any new customer. They were going after the biggest ones.
Okay, and this one reveals a really critical detail. This pivot wasn't just about moving more boxes from point A to point B. If you look at the U.S. market, both the amount of clothing being sold and the price per item were dropping. But look at the EU. Not only were they buying over 21% more stuff, they were also paying a higher price for it. The EU basically became a lifeline for both volume and value.
But, the story is never as simple as just swapping America for Europe. The global trade map is way more complicated than that. This pivot was happening all over the world, really, with pretty mixed results. To get the full picture, you kind of have to zoom out and look at the whole map. Yeah, traditional markets like the US and the EU are massive, but they're not the only game in town anymore. China's Belt and Road Initiative has created this huge new network of trading partners that's now technically even larger. This is the new global chessboard where these trade battles are being fought. And if you look around that map, performance was really all over the place. Exports to Japan, they actually bounced back, which was a good sign. But then you look at the nearby ASEAN countries, that's Southeast Asia, and exports there actually fell as their own economies were feeling the pressure. And even in those super important Belt and Road countries, growth had slowed to almost nothing. It just goes to show you how tough the global environment really was. So the industry managed to dodge a huge bullet by shifting its markets. They kept the goods moving, kept the factories open. But that brings us to the final and I think most critical part of this story. What was the hidden cost of all this frantic reshuffling? What exactly was the price of this pivot? This quote from the analysis really cuts right to the heart of the problem. While all these companies were scrambling to find new buyers, there was this really dangerous trend happening just below the surface. Prices were falling, and that meant profit margins were getting squeezed hard. And this is exactly where that hidden cost shows up. So while the total value of all exports looked okay, mostly thanks to that huge surge to Europe, the actual price they were getting for each individual item, for a t-shirt, for a roll of fabric, that was falling. They were basically having to run faster and sell more just to make less money on each sale. I mean, this table just lays out the painful trade-off perfectly. Look at yarn. The volume they exported shot up by almost 16%. That's great, but the price they got for it crashed by over 10%. Same story for fabrics. Volume up 9%, price down almost 10%. Even for finished clothing, the pattern holds. You sell more, but you get less for it. So the main takeaway here is pretty clear. The Great Textile Pivot was, in one sense, a huge success. It kept the factories running, it kept the shipping containers full, and it saved the country's export numbers from total collapse. But that success came with a very steep price tag, and that price was profitability. So let's just quickly recap the whole story here. First, U.S. tariffs ignite this massive crisis. Step 2, Chinese exporters pull off this incredible, rapid pivot, mostly towards the EU, which saves their overall export volume. But then, step 3, we find the catch. This whole desperate scramble for new markets forced them to slash prices, putting their financial health in serious jeopardy. And all of this leaves us with one final big question. This whole maneuver kept the industry from sinking, for now. But a business can't survive forever just by moving products. It needs to make a profit. So if those profits are getting squeezed to zero, something, somewhere, has to give. Who's ultimately going to pay the price for this costly pivot? Is it the companies, their workers, or will those costs just get pushed somewhere else down the line? It's a question that's now hanging over the entire global supply chain.